Hey, what's up, guys? I'm going to talk to myself for a minute and then I'll put it out later, the recording out later. So welcome back. I haven't live streamed. I didn't live stream on Monday. Kind of had come to Jesus a moment about my content, and I'm starting to cut back on my amount of content right now. Currently today, hey, what's up, Green? I'm recording this. I'll make sure to put it out. Today I'm working on another premium post. I want to do 2 a week now. So I'm going up on my premium posts, down on my other posting and my other live streams. So Tom Wright, what's going on? So yeah, those are the changes I'm going to be making to my content. I've been doing this for a long time and wasn't getting the traction exactly that I wanted. And so what I'm going to do is I'm going to move a little bit more exclusive with my content and make it more premium and cut down on the free stuff and the free live streaming and all that. I've seen a lot of communities on Telegram that have thousands and thousands of subscribers. Like in close to the tens of thousands of subscribers. And so really concentrating on the Telegram community, the premium content, building up real hardcore base here while paring back a little bit on my full-time schedule for creating content. And that's going to free me up to go out there and subsidize this passion project of mine with starting another little business on my own outside of this and splitting time with this and that other business. So that's my plans for right now. And we will go and see how that works out. So today, just looking who else is here. Jason, what's going on? I am going to, of course, put this recording out in the Telegram group. So you only missed about 30 seconds at the front. But today is FOMC day. I'm going to be responding to that when it drops. I'll share my screen. So this is, you can just Google FOMC calendar and it should be the first link. And then you can go here and get their meeting. This will not be an SEP, which is the summary of economic projections that comes out quarterly. And you can see here March, June, September, the ones with the asterisks. That's when we get a new dot plot and all that stuff. If we go to the CME FedWatch tool, it's at 99.5% that we will get no cut, no hike, just a pause. So that's what I'm expecting as well as my base case. If we go here to the premium post I was writing, I might cut this section out now since I didn't get it done by the time that this was going. But I said the base case is for the Federal Reserve to not surprise the market. As of the time of writing, 99.5% chance. Many people think that Trump could apply pressure to Powell to cut rates to stimulate the economy, helping his very significant political reforms. But I think that is overblown. I don't think this is very likely. Powell was asked in a press conference if the president can force him out. Powell calmly said no. He did not seem concerned in any way. Secondly, Trump is known for not overstepping actual separation of powers. Some people think that this funding pause is overstepping, but his constitutional authority, overstepping his constitutional authority, but is not. Biden paused funding as well for limited projects, but he paused funding as well. Every president does it. It's just crazy radicals trying to make a smear stick. Third, the economy is actually doing all right at the moment. At least on the surface. There might be tension building in the shadow banking system. And, I'm a cyclical person. I think we are going into recession. We're approaching a recession. We're in a pre-recession period where things start to deteriorate. I think Trump's election has pushed off a recession a little bit here because people have optimism, and optimism can be seen in higher interest rates and things like that. So, but we are seeing the rise of the dollar and a reversal of interest rates. but nothing is acute yet. The odds I have is about a 20% chance of a cut, so higher than the 0.5% that's priced in, which is a big difference, but it doesn't change the base case, and that's that we get a pause. Okay, so that's what I was looking at today. Refresh this. Still nothing. 159. 1 minute to go. Let's see who jumped in here. User 1. What's going on? Point. Sven. Dan P. Nick 6. Did a little bit, 2 minutes about my content up front, guys. I will be publishing this audio in Telegram once we're done here. Basically, trying to add more premium, less overall, cut down my time, start another business on the side to supplement this business, and yeah, go from there. So, Milan, what's going on? We are at 159. Going to refresh here again. Nothing. You guys can find this by Googling FOMC calendar, which should be the first result. If you go down here to some of the other years, you can see when there is an asterisk, then there is a SEP, the summary of economic projections. And you can get all the different data here that you want. But we do not have an SEP, so no dot plot. Here we go. It is up. Let's open it up and see. In support of its goals, the committee decided to maintain the target range. Okay, so they paused. They did not cut or raise, which was the base case that we were looking at. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue to reduce its holdings. Okay. So it will continue the QE, letting stuff roll off the balance sheet. They're not selling anything. They're just rolling it off, letting it mature. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective, of course. I want to see if there's anything in here that mentions anything about the tariffs. Recent indication. Let's start at the beginning here. Recent indicators suggest that economic activity has continued to expand at a solid pace. That makes me think of this one here is oh no, that's the nowflation. GDP now. That's what we're looking for. GDP now had a big adjustment today, as you can see. This big dip here, if I can make that a little bit bigger for you guys. We had this big dip here just today, still over 2% on the GDP, but going from about 3.1, 3.2 down to 2.2, 2.3, something like that on its latest estimate for GDP in Q1. Oh, no, wait, this is real GDP estimate for Q4. Okay, so this is just making sure this is for Q4. Okay, this is the last GDP Now forecast for the fourth quarter. Yeah, that's right. The first GDP Now forecast for the fourth quarter will be on Friday. Or sorry, for the first quarter will be Friday, January 31st. Okay, so this is our last update, and you can see it crashed. There are other charts here. I don't know where to get them on this website, but I do have them on my Twitter. If we go, I tweeted about it earlier, and here's the one I'm looking at. So this has changes in the subcomponent contributions of GDP Now, real GDP growth forecasts. We have purple that's significantly negative, the most negative for a long period of time here, and for that is change in private inventories. And this lighter blue is net exports. Okay, so they're expecting net exports to drop very significantly, and also a change in private inventories, which matches, right? So if you have fewer, your import-export balance is affected, right? Because it's net exports. It's not just exports. It's net exports minus imports. But that matches with a drop in inventory. So if you're getting less imports, you're going to have more inventory being eaten up to make up for that. So that makes sense that those two things are the big negatives here. I would think that government spending will start being negative due to all this stuff going on with the government. But okay, so that was GDP. The unemployment rate has stabilized at a low level in recent months. No, it hasn't. It started to tick up and then it ticked down 1 month. But we will see if the next payrolls is going to be surprising with revisions. I think it is likely to have at least revisions in the direction of higher unemployment. Whether they're very significant or not, we'll have to wait and see, but I think there will be revisions. And unemployment will start turning over again as well. Just think about all this spending that has been paused that we talked about a minute ago. That can lead to a loss of a lot of jobs. Okay, if you're talking $1 trillion of spending being paused for 90 days, you're looking at 250 billion, a quarter of a trillion in 90 days. That's a lot of money that's not going to be going out that could lead to a lot of job losses. In addition, they're trying to get a lot of people to just quit from the government. There have been layoffs as well. Not a ton of numbers from the military, but it's in the thousands, I think, that have been let go. And so the unemployment rate is going to start to tick up just because of those things. And it could snowball on itself, especially if we already have some problems in the shadow banking system. Like I talked about, we can see through the rising dollar and now the 10-year rolling over a little bit. So the labor market conditions remain solid. Inflation remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. I just want to mention this. I haven't talked about this in a month or two, but I've seen that meme going around Twitter again about Powell not being able to describe why they target 2%. It goes back to Milton Friedman, Chicago School, the last great economic academics, and they were monetarists. And Milton Friedman said, if you target money supply, or you target interest rates, or you target stuff out there, you're data dependent. Like the Fed claims that they're data dependent. If you target those things, you are by definition including a lag in your monetary policy. So the economy will start to turn over. You'll look at the data. They'll still look okay. Then the next meeting, okay, now it's really bad. Maybe you think about cutting. But then the monetary policy transmission, which is from the actual action of moving your policy rate, how long does that take to affect the economy? Now, I think that's bogus. It doesn't really exist, but they do. And so they would think that there's going to be this lag in monetary policy transmission. And there's lots of ink spilled about monetary policy transmission, especially over there in Europe, because their markets really just follow the American markets, the American monetary policy, more than, I would say, the ECB. So they're kind of impotent in that way, and they do a lot of studying on monetary policy transmission, but it's kind of like doing research on ghosts. There's nothing to find, but they can always write papers and claim that they found some very insightful thing about monetary policy transmission when it really doesn't exist. They're studying the wrong things. They need to study like mass formation psychosis, mass formation psychology. Then they can figure out their monetary policy transmission. But there's nothing like mechanical that's being transmitted. It's kind of a ridiculous word. So anyway, built into data dependency is lag. Okay. And so the monetarist said, we can't do this lag because it's so uncertain. If it's lagging by 12 months, do we want to make monetary policy today on our forecast for 12 months from now? No, not really. And so, especially dependent on data now. So the now data isn't showing us this forecast for 12 months that we think is possible, but now we're supposed to be making monetary policy for what it's supposed to be in 12 months. It's just completely mixed up. And so they said, we just need to target money supply growth. So that's why they started targeting the 2% or 3% growth. Monetarists, I think, Milton Friedman, he was like 2.53%. It also matches, ironically or not, with the amount of gold inflation. So when we're on a gold standard, the stockpile of gold goes up every year by 1.5%, 2%. And depending on the price and the demand and all that, but on average, about 1.5% to 2%. And that matches this 2%, their inflation target. I don't think that's a coincidence. I think Powell knows this, but he can't explain that in a soundbite to Senator Warren because, it doesn't, like, how long did that just take me? 5 minutes to go through that? He's not going to get it out in a 60-second soundbite that's at all intelligible. And so that's why we target 2%. But most people say it's arbitrary, and it's not. It's not arbitrary. There's lots of academic work around it, and it also mimics the gold standard. And so, sorry, I have a little bit of a cold here. And so that is what we're left with. That's why we target 2%. All right, long tangent. Committee judges that the risks to achieving its employment and inflation goals are roughly in balance. What does this mean? Sorry. So for those people that don't know, let's see who's in here. I think I've only not seen Bread. What's up, Bread? So roughly in balance, you guys know there's a dual mandate, this maximum employment and stable prices. And during COVID, what's up, Eastside Tony? During COVID, inflation took precedence, right? And so they started raising rates dramatically, kind of putting maximum employment on the back burner. We're at historically low unemployment rates and all that too. And so this was out of balance. But now inflation seems to be under control. I think we actually, the dangerous downside to inflation, or to prices, I should say. I hate having to say that exact every time, but no, to the CPI, the downside risk is the risk is to the downside. And employment, the risk is to the upside. But they're saying here it's roughly in balance. The economic outlook is uncertain, but they said solid pace up here. Now they say economic outlook is uncertain. And the committee is attentive to both risks to both sides of the mandate. Okay, so that is that. Let's see what the markets are saying right now. Dollar. I mean, ever so slightly on the news, but nothing significant. Did not surprise the market. Bitcoin slightly down, matches the dollar. 10-year has reacted very, very positively. One thing I pointed out here for the 10-year recently, I don't know if I put it in Telegram, but it was on Twitter. This is a nice head and shoulders, and it doesn't quite match with RSI. So RSI for head and shoulders is supposed to max out on the first shoulder. This maxed out on the head. But this side is nice, and it is kind of generally downward sloping with the MACD agreeing as well. So we'll see if this materializes. This would be the neckline. And then anything above this swing high right here, 4.65 would invalidate it, at least for the time being. But we could see something like this, make a higher shoulder, and then go down. That is less convincing, but there are such things as double shoulders. So That's possible. But I don't think that there's going to be any sort of new high here. This was extreme, in my opinion, and we'll see how this turns out. Okay, oil. Oil was down on the day earlier, still down on the day. No real reaction at all to this. And stocks, finally, U.S. slightly down, gap down. Tried to close the gap. And if we go to a daily, we might have closed this gap. Isn't that amazing, guys? So we close this gap right before the FOMC. I'm trying to make it bigger for us here. Come on, man. There we go. Now get in the middle. All right, so what I'm talking about with closing the gap here, this close price, I mean, it might have missed it by $1. And really the gap, I guess you would say, is up here. Going back to the hourly. I know this is a 4-hour. So when was this? Thursday. Okay, so that's not really the gap. The gap is up here, but it closed the gap from last week. You could say the weekly low. And it's going down. Anyway, I just find that interesting. Okay, so that's it. Let me see if there's any comments here from Telegram. User one said, Trump implied he could tell the Fed what to do. When that reporter asked him about it. Oh, yes, Trump did. Yeah, I remember that now. So when the reporter asked, do you think like Powell will listen to you? And he said, yes. There is I did tweet about this as well today. There is a history for strong arming. And it's right here. One infamous anecdote describes Nixon summoning Burns, that's Arthur Burns. He was the FOMC chair in the 70s during the Great Inflation, and then right before Volcker came in 1981. He summoned him to the Oval Office, where he berated him and even physically intimidated him, shouting and pounding on his desk to ensure that the Fed kept rates low. I say that won't happen today, but there is higher than usual chance of a surprise policy decision in the next several meetings. So, yes, I mean, Trump's not going to admit that he can't do anything. He is a very shrewd negotiator, and yeah, he'll see. But the way I see the fight, the battle, is, okay, there's several players. One is the people. Okay. And within the people, there's other smaller players. Obviously, there's extreme radical Marxists that are in power in the Democrat Party. Then there's like moderate Democrats, the old school JFK Democrats. They're still around. Then there's the moderate conservatives that are kind of more rhinos, more pro-business, low taxes, that kind of stuff. And then there are the MAGA people. And then there's also the extreme right, which, you know, would be like the woke right, if you will, or the ethno-nationalists and stuff like that. So do you have this? That's the people. And the vast majority of the people, 80%, 90%, probably 80%, are just the people, middle of the road America. And so that's the dominating faction for the people. Then you have the globalists, the Marxist globalists. They're the ones in academia. They're the ones at Davos. They're the who have taken over most Western governments. They're the Trudeaus and the Ursulas, the Starmers, you know, all those types. And they are losing power rapidly, but they can't pivot. They can't pivot because Marxism is not a backwards ideology. You can't take a step backward. it has to form a new antithesis. So you start with the thesis, which is current day situation, and then you go to an antithesis, and then you're never going to get to the antithesis. That's like a perfect world. So then you take a halfway step to the synthesis. That's the Marxist dialectic. And the problem I think the globalists have right now, this is kind of out of the scope of this podcast maybe, but the problem that the globalists have is not only that they can't take a step backwards, but they cannot agree on the current situation. Like I remember watching People's Pundit, a great YouTube channel, especially during election season. And his kind of debrief of the whole leading up to the election was they bought their misinformation. So the radical Marxists, they believed the fake polling. They still believe that they are like a majority of the political opinion in these countries. And maybe they are in some completely brainwashed, cucked countries. I don't know. But they're not in America. Okay. And so they believe it. And that's why you see all these pundits can go on and say the same misinformation about the Charleston speech. Is it Charleston speech? Where did he say that? The very fine people thing. Can spout all of this misinformation about all these people, these lies, and do it with straight face over and over and over again because they actually believe it. They're not lying to you. They're brainwashed, completely brainwashed. And so that's the problem with the global Marxists. Not only that their ideology can't take a step backward and reassess and say, what did we do wrong? Where are we wrong in our messaging? No, they actually believe that they are right, that they're the popular ones. So, and maybe those two things are the same. I don't know. Okay, that's another group, global Marxists. They're going to get violent before they go away. And then you have the bankers. That's more online with this podcast, but the bankers, and they're usually somewhat seen as working against the people. They're not definitionally, they don't have to be against the people, but they tend to be seen as elitist and kind of oppositional to the people. But right now, what happened in COVID, of course, was that the globalists let the masks slip, and the bankers were like, oh shit, they can actually shut down the entire country. They can do everything to us, and we have no power. Oh shit. And so that's when the bankers actually joined the people against the globalists. So that's what we see right now. And so when you look now, think of that situation about Powell and Trump in that light. Okay, they're on the same team right now, but there are subtle disagreements. There are subtle differences in incentives for these two people. Powell instantiates the banker class, or manifests, or whatever word I'm looking for, represents the banker class, and Trump represents the people and a little bit of elite. I mean, you got to know Trump. He's a billionaire. He goes in billionaire circles. He's a little bit of the elite class, but really he's representing the people with a slight. He's actually a good representation of this three-headed monster that I just described, because the elite bankers and the people have joined forces, and that is kind of embodied in the person of Donald Trump as well. Wow, that's interesting. So you have Trump and the people versus or kind of in a little disagreement with the bankers, but they're still on the same side. So I don't think there's going to be any pounding of the table, physical intimidation, or anything like that going on here from Trump. He will use the art of persuasion, but he knows that he is going to be negotiating with bankers, with people that he's known and talked to in the past. And really pretty much back him at this point. And so I don't think he is going to want to alienate them. User wants it. Okay, same size, subtle differences, maybe incentives line up at times. A matter of timing. Yes, it is a matter of timing. Bankers, I mean, everybody will act according to their incentives. Everybody. If you put a diehard, like how many times have we seen this? It's very, very rare that this doesn't happen. But you have a anarcho-libertarian type, anarcho-capitalist, and he makes $100 million. And then he gets, people think that, oh, you know, making that money changes you. Well, no, it's your incentives have changed, right? You can take people out of one group, put them in another group, and they will act as if they are from that group because we are incentive following robots for the vast majority. I mean, there is a little bit of free will in there as well, but we will always act our incentives. And so, yeah, right now it's because they aligned, their incentives aligned, and they will continue to align, actually, if you think about where this is going. So the global Marxists have not lost yet. I mean, I think they will lose, and it's just a matter of time, but things can really snowball. Like, look at what's going on in Europe. Okay. They have overturned a couple elections. They're threatening to overturn the German elections. So the elections that they've overthrown, we had Georgia. That was some stuff going on, and I don't even know if you should consider that Europe. It's kind of East or West Asia, but you had Georgia, then you had was it Romania, right? And then now they're threatening to do it in Germany as well, the largest economy, and that. So what happens when they start overturning elections because they're in the positions of power? They can't play within the rules. They have to change the rules, manipulate things, and that's gonna lead to major civil unrest. Major civil unrest. And so it can snowball very quickly, and it can happen from just one or two decisions from the global Marxists. And remember, they think they're right, and they cannot move backwards. So it's going to escalate. It can only escalate. In the U.S., kind of a unique situation. With the way that we have elections for president, the embodiment of this people banker alliance that is still somewhat vigorous in the United States, embodied in the person of Trump. And so that's a little bit different. Like, for example, Germany doesn't have any billionaire that's running for office. UK either, right? France either. So they don't have this billionaire elite people, voice of the people. And so it's pretty unique in the United States. And as the United States goes down this road, and hopefully these reforms make a big difference, more and more people in Europe are going to get more and more jealous and more worried about their own country versus look what's happening in the United States. And so it's just going to push it further and faster. So yeah, I see escalation happening all over the place. Okay, so getting back to this, stocks are down a little bit. Let's see, Bitcoin pretty much unaffected for the day on this. They did not surprise anybody. Any other comments? I don't see any other comments, so I am going to end it there, guys. Like, I'll end it with how I started it. My content over here on Bitcoin and markets, I had a come to Jesus moment, and I said, look, this isn't monetarily worth it for me right now. And so I decided to kind of skew my content more towards the premium and less towards free content and stuff. still do live streams, but change it up. I like live streaming here just on Telegram, and there are Telegram channels with tens of thousands of people. So it can scale from where we are right now, which is, what are we looking at? 731 subs. So it's decent, but if we could get that up to 5,000 subs in this Telegram and a premium content going twice a week with these live streams and stuff, I think that's going to be even more successful than I was doing the old way. And I have changed my content around quite a bit in the past. So this is just another iteration of this. Oh, you guys were commenting in this other thing. Oh yeah, tomorrow the Czech National Bank will vote on stacking 7 billion euros worth of Bitcoin. Oh, that's a big deal. Hopefully they get it. They've been very Bitcoin friendly with some of their regulation recently. Oh, Dadunch. Puddington Bull. You did, because she's always lying. Christine Lagarde, even worse than that. Oh my gosh, you guys. I really think Christine Lagarde is an idiot. I think she's kind of dumb. But the reason why she has these positions of power is because she's so freaking corrupt. But I think she's kind of dumb. Same way I think Janet Yellen is dumb. I think she's a really stupid person. But she's had these political powers because, one, she's a woman. Two, she knows how to play the game, and she will do what she's told. Right? So Janet Yellen is an idiot. Lagarde is an idiot. I think von der Leyen is kind of she is a dangerous, dangerous person. Like, if I knew her in person, I would be scared to get on her bad side. She's kind of like a Hillary Clinton. And it's funny that she has that same haircut. But, I think she's a physically dangerous person to be around if you cross her. And she's the type of person that I can see ordering, like, assassinations and stuff, not a good person at all. DT, you said even an article explaining the flaws of the current metric. Yeah, we were talking about Bitcoin dominance earlier. That's a good idea. Maybe I'll do that. I pronounce it Floxer in my head, or Foxer. I say Floxer, but Foxer in I'll have to check out your Substack, man. Put a link to it again. Oh wait, you put it in here. Okay, great. Sorry guys, just scrolling, catching up. All this stuff about DeepSeek. You guys know I'm an AI skeptic. DeepSeek produced a model close to the performance of U.S. models 7 to 10 months older for a good deal less cost, but not anywhere near the ratios people have suggested. DeepSeek version 3 is not a unique breakthrough or something that fundamentally changes the economics of LLMs. Okay, well, I agree with that. It's been reported DeepSeek actually had 50,000 Hopper generation chips. Yeah. Eastside Tony, yo. Dan P, I should do more affiliate marketing. I'm open to it. I'm just not, I don't have the audience, do not have the audience to make affiliate marketing a thing. Like, if I was getting 10 times the views or 100 times the views on YouTube and in the podcast listens and stuff like that, then yeah, affiliate marketing can be good money, but not when you're in the hundreds, when you're in the tens or hundreds of thousands. Yeah, let's see. At the end of my, hold on one second. At the end of these, I had affiliate links, I thought. Maybe it's just the podcast. Let me go back. We'll see. Yeah, I had some affiliate links here, like for TradingView. This Generate Press one is very old. This one I used WordPress years and years ago, 5 years ago or more. And Audible. Yeah, I can maybe plug those a little more. Thanks for suggesting that. I'll make sure to put those on everything I do. All right. So what else can we talk about here? User one said, really appreciated your concise TA and market commentary format in your email where you announced your transition. Oh, thanks, man. Yeah, that's the typical format here. So do really simple TA. I'm about simple TA because it is all about shelling points, in my opinion. Shelling points that for people that aren't aware of what shelling points are, but most of you probably are. So if I have 4 boxes, okay, 2 by 2, 4 boxes, 3 are green, 1 is red, and I'm a professor, and I have 2 students, and I tell one student, or I tell both the students, if you guys pick the same box, you'll both get $5, okay? But you can only pick one box, right? Which box are you going to pick? Most likely, they're going to both pick the red box. Why? It should be 25, 25, 25, right? But it's not. It's probably like 99 to 1 that they're going to pick the red box because of shelling points. There's something unique about that box that stands out that, according to the game, is supposed to be important, that makes your attention go there. So when you look at a chart, okay, let me find a chart here. That's a good thing. Moving averages. Okay, so you look at a chart and you have all these moving averages, but people are looking at these moving averages. People build indicators based off moving averages. Like a great example for the 20-day is B bands, the Bollinger Bands. They're based on the 20-day moving average. And so these moving averages have a lot of eyes on them. A lot of people are looking at them. And so those levels are significant. That's where a lot of bids and asks, a lot of the trades happen around there. Okay. And so when you're looking at these things, it's important to see where other people are looking and base your TA around some very simple things. Other powerful indicators are, I like the cloud. I know it's not as popular in, say, Bitcoin or other simple stuff, but the cloud is pretty darn popular with like professional traders and stuff. And so I think this is important. And, it's even based on moving averages. So the key June, I'll have to look this up real quick. What is key June's based off of? Not exactly a moving average, but key June is standard in Korean. Oh, that's not right. Okay, so the Kijun line is a moving midpoint based on high and low over a set of number of periods. So that makes sense. So, you know, people's attention is going to be within the range of prices maybe that we have gone and that are limited by highs and lows, previous highs and lows. A moving average is different. It sums up the closing price as a set of number of periods, then divides that by the number of periods. Okay. So yeah, it's based off highs and lows, and that makes sense why a low price might attract a retest, right? And so when we talk about the Kijun, where was I on this? When we talk about Kijun is tested a lot. So if we go like here, just recently, oh, this is a 4 hour. You see that on the 4 hour, it hit the Kijun. Let's go to the daily. And this is extended settings based off 24-hour trading. So this went through the Kijun back here on the 27th. Let's see if I can find any other Kijun tests. Here's a Kijun test right here. If we go back to October of 24, that tested the Kijun, bounced off of it. So that makes sense. Okay, so that's kind of why that one is important. TD sequential is a timing indicator that talks about like how much time in a trend, and it is very exclusive. Like the TD sequential is hard to find on TradingView. It's TD off of Tom DeMark, or named after Tom DeMark. It's proprietary, and they squash people using it. So we'll see if I get any cease and desist letters about this. But TD sequential is proprietary, high-powered signal that lots of professional traders use. RSI MACD, very, very simple momentum indicators, and they are used by everybody, and also in a ton of different indicators. Like people, I think this is the case, at least it seems to be the case, that the MACD, there's a lot of indicators based off of MACD. Maybe some of the most numbers of indicators. But like if you just have a simple algorithm to compare these two with the price, you can make all different sort of indicators, but it's all based off of very simple things that people package up and they sell proprietary, right, to make a little money. They sell you a $200 indicator that they made off of RSI and MACD. Where if you just read RSI and MACD, wouldn't need that shit. So anyway, that's what we're talking about here. So yeah, thanks. I try to keep it simple for that reason. All right. So that's going to be it. Let me check and see if there's any other comments before I get out of here. I'm not seeing any more. All right, guys. Well, that's it for this live stream. The press conference should be going on right now, actually. Should we go? Let's just go. Let's just go. Stand by 1 second. Oh, it's already on the questions. So let's share screen. Let's go. Actually, since we're behind a little bit, before we do that, let's go to the markets and see if those initial comments. Oh, Bitcoin jumped. Bitcoin jumped 2K. Wow. Okay. So he must have said something dovish, huh? Up to 103.1 now. Oh, nice Darth Maul candle. Let's see about stocks. sold off initially, back up here. US 10-year kind of down from its recent up. The dollar coming back. Very interesting. So now let's go back to Powell and listen.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made...
He has a frog in his throat too.
Significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low.
It is really amazing how everything has stabilized. But remember, they can't fix anything in the economy. It's baked in the cake that deflationary forces will win out. You know, Mises would say that you can't avoid the end of a credit bubble indefinitely. And that's what we have here. We have the end of a 75-year credit bubble, which the end of that is deflation, you know, crashing of credit, popping of credit, shrinking of the money supply. So that's the inevitable end. But you can't have periods of reflation. Usually you have to hit like rock bottom, then you can come back with some reflation. The Trump election has been extremely unique, extremely fast-paced just in the last week. And so, I would say there is some extreme optimism right now out there. But that will wear off, and the overriding pressure of deflation will once again win. And we are still seeing some signs of that. So, like I said, the dollar is a big sign. And interest rates going up was a sign of optimism, but now as they're turning over, like we showed there in the last couple of charts, US 10-year is coming down now, and that is also a sign of starting to see some tightening. It's not so much the level, the absolute level, it's the direction. Okay, so if money is loose, the interest rates should rise, and if money is tight, interest rates should fall. But absolute level we're at is not as important as the directionality. Okay.
Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance.
Do not need to be in a hurry. Okay. We'll continue here in a second, but remember our discussion we had a little bit earlier about the monetary policy transmission and the lags built in. And so He doesn't believe that those 3 cuts really are priced in yet, even though he just said that they have made some progress there due to that. But he really doesn't believe that, or that's not within his textbook. Okay, he's just saying that. Also, if you think that lowering rates is stimulatory, you have to think that those full effects aren't in yet, and you have to be bullish right now. You literally, that's the end state of your mechanical view of the Fed, is that the monetary policy transmission lag is, they can't tell you exact when it's shorter. When it turns out shorter, they'll say it's shorter. When it turns out longer, they'll say it's longer. But it's anywhere between, like, say, 6 and 24 months. And anything longer than that just becomes unbelievable. And anything shorter than that doesn't really fit in their idea of monetary policy transition and lags and stuff. So 6 to 24 months. And so what does that mean for this year, 2025? It's going to we're still going to feel more stimulation from that first round of cutting. It's not over yet. So you have to be bullish. And I think a lot of people are going to get caught on the bullish side. And this stuff is going to start falling. Recession is going to become more and more apparent as we move throughout the year. One thing I do agree with Luke Groman on, which is usually not much, but I think it's going to be, if you're cutting $1 trillion in the budget, it's going to be really hard to avoid recession. Impossible, pretty much. And so as we move throughout the year, we'll probably expect to see that going into recession.
At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our...
Yeah, it's not hard to be a central banker. You just do what's priced in. That's about it.
Policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we'll be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer-run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy.
That's interesting that he put that in there, because a lot of people are talking about they're going to up it to 3% because it's going to be higher for longer. But he's pretty much squashing that right off the jump, saying, no, 2% is it. And I think he has to. I mean, the central banks don't have that much credibility at this point, and so they can't waste it on changing their targets.
Maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Mr. Chairman, Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or from to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a 3-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if any, does a president making these kind of remarks have on policy? Thank you.
Three questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicating this demand to you?
I've had no contact. Thanks.
Very interesting. That's the first thing, and that's what I wrote about in the premium stuff. First question was on that. He does not seem concerned one bit, which I wouldn't be. So I think Trump might think he can jawbone it down, and the same way the Fed does.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was meaningfully restrictive. Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed. A couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So we really look at the movement toward the goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive. And for that reason, we're going to be focusing on seeing real progress on inflation or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates? And would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market to achieve that goal, and that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance, and I'd say you look at the last couple of inflation readings, and you see we don't overreact to two good readings or two bad readings, but nonetheless, the last couple of readings have suggested more positive readings. So I think policy is well positioned.
All right. I don't agree with a lot of the mechanics of what he's saying. He's building a narrative, but I have to say that, he could go down as one of the best central bankers, chairman of the Federal Reserve. He could go down as one of the best. He really has done a good job of saying absolutely nothing, yet sounding like he's saying something and calming the markets. So, yeah, I think he's been if you say there's this necessary evil and it is that you have to have a chairman of the Federal Reserve, Powell is one. I think that's pretty good. But of course, we should end the Fed. We don't really need a Fed. And especially if you go back like on a Bitcoin standard, our commodity-based standard, the need for the Fed is much less. So hopefully that happens.
Colby from the New York Times. Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
No. So let me look. If you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market, and we just chose to shorten that sentence. Again, if you look at the sort of intermeeting data, it was good, and there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret two good or two bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to follow up, we've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer end, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, actually are not really beginning to see much. And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do, this is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand, and kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
Michael.
Michael McKee from Bloomberg Television and Radio. You and your colleagues normally condition future policy moves with the phrase, if the economy develops as we anticipate. Is it fair to say that since there's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing?
Well, at all times, forecasts are conditional at a minimum on just a set of expectations, and they're highly uncertain in both directions. We know that economic forecasting is really difficult beyond just a month or two out. So in the current situation, there's probably some elevated uncertainty because of significant policy shifts in those four areas that I mentioned: tariffs, immigration, fiscal policy, and regulatory policy. So there's probably some additional uncertainty, but that should be passing. We should go through that, and then we'll be back to the regular amount of uncertainty. So, what forecasters are doing, not just us, but everybody's doing, is they've got sort of just a set of assumptions about what might happen, but they're really kind of in the nature of a placeholder, and meaning, plausible could be, but honestly, you wouldn't stand behind it because you just don't know, and so you're just on hold waiting to see what comes down. And, it's a very large economy, and policy is affected at the margin, but we're going to wait and see.
Well, if I can follow up, the idea that you feel that policy is restrictive suggests that the Fed in general wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you can cut, or data that will tell you should hold?
We're looking. It's more the way it works is we are looking at the data to guide us in what we should do, and that's what we do. And right now we feel like we're in a very good place. Policy is well positioned. The economy is in quite a good place actually as well. And what we do expect is to see further progress on inflation. And as I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster. We could then be in a position of making further adjustments. But right now we don't.
All right, nothing exciting here. My kids just walked in. Nothing really exciting about the last couple. He's just going to walk a tightrope and try not to mess up, try not to say anything that's going to spook the market. Overall, like I said, the economy is in a decent place right now, but it's a slight bit of reflation. He talked about an increase in uncertainty. I don't think that's what's going on. It's actually an increase in optimism. And then, like he said, it would return to the regular level of uncertainty. It's going to return to the regular level, and eventually it's going to wear off and start. They're going to realize, oh, these new Trump policies, they didn't really make the difference that we thought, or they didn't save me from having to close my business and lay off 100 people or 10,000 people or whatever. So the reality is going to sink in after another few months, just like he was talking about, except I would use different words. So overall, kind of a nothing burger from this. Let's take a look one more time at the charts and see. So Bitcoin is up 103.4, got as high as 103.9. So we'll see what happens. But that's going to be it. Let me just take another look and see if there's any comments. Not seeing any. So we are going to sign off for right now, guys, and I will see you around on the Telegram and Twitter. Bye.